You might have an 800 credit score and not be very fundable in the business funding world. Hi, my name is Matt Coach. I created this YouTube channel to share the tips, tricks, and mistakes on my way to building an 8-figure real estate portfolio. And most people look at their credit score as, that's the only thing that they understand is that they have a credit score. It's a certain score. 800's really good, 700's pretty good, 600's not that good, 500's bad, below 500's really bad. That's most people's understanding of credit. But your score itself is not the only thing that matters as far as your fundability as a person. So credit score is broken down in 5 different categories, with 35% being your payment history, 30% being your debt utilization on your revolving accounts, and 15% being your credit age, 10% being credit mix, and 10% being new credit. So if you reverse engineer your credit score, right, you take a little bit of a hit every time you get new credit. But you need a certain amount of different credit, so credit cards, mortgages, auto loans, student loans, personal loans, to help build that credit mix side. And then the longer you have those accounts, your credit age, the higher your credit score is going to be. And if you have a credit card and you don't use a whole lot of it, your utilization is going to be low on your revolving accounts, and that's going to keep your score up. If you've always made your payments on time, then that's also going to boost your score. So somebody who is, say, 40 years old, right? They bought a house, they've paid their mortgage on time, they bought their house 10 years ago, they've always paid it on time. They have an auto loan for a new car they got 5 years ago, they've always paid it on time. They have their student loans from college, they're still paying those, they've always paid those on time. They have one credit card with a $2,000 limit, they put Netflix on it, and that's it. Every other thing they do, they pay with for cash. This is probably a pretty responsible individual based on the things that I just mentioned, right? They're never missing any payments. Doesn't seem like they take out a lot of debt unnecessarily. So now they are a financially stable individual. Their credit score is going to be well into the 800s. So you're probably thinking that, hey, if that person is supposed to start a business and they are personally guaranteeing debt utilizing their credit score, that person is probably extremely fundable, right? Because they've shown that they're really responsible with money. And that's not exactly the case. Because if that person never uses revolving debt like their credit cards, so they have very low limits on their credit cards, they don't have a comparable credit profile to allow themselves to get higher limit business funding. So when someone goes to pull their credit report, they're going to go, awesome, you have an 800 score. If it's something like a mortgage or an auto loan where they're just qualifying your interest rate based on your score and you need to have a minimum amount to qualify for that loan, they're going to get lower rates. But they won't be able to get these high-level business credit cards, these $50,000 credit limits, because when they look at their credit profile, they're like, well, you're responsible with the payments you currently have. But how would you be able to deal with a $50,000 revolving credit limit? Doesn't seem like you have any proof that you can handle a large amount of revolving debt. So it's important to build out your credit profile, not just having a good credit score. So that's something to know. And obviously, if that person goes to build a new credit profile, right, and they go and say, well, I'm going to go get 4 or 5 new credit cards to build out that profile, now they're going to have all this new credit on the report that's going to lower that overall credit score. They'll still probably be, based on the things I said, a high 700s, maybe and still a low 800s individual, but that's going to take some time, and banks are going to look at that as risky. They just took out a lot of debt right now into their own personal name, and so they still don't have proof that they can pay that revolving debt and be responsible with it. So understanding how to build your credit profile is very, very important if you're looking to build out business funding for a business that you're starting. So not just, hey, I have an 800 credit score, that's really good, right? It's also, hey, I have 3 or 4 $10,000, $15,000 credit cards inside my account. I've always paid them on time, and they're with good, high-quality, upper-tier banks like Chase or Wells Fargo, U.S. Bank, those Tier 1 types of banks. So building out that credit profile. Very, very important if you want to actually get personal funding based on your own personal guarantee for your business. Sorry. See you later.